am Mariel De Castro and I am the head of the Sales and Distribution Group of BPI Investment Management. With me here today is the head of the Fixed Income Investments Group of the Asset Management Group of BPI, Vice President Smith Chua, to give us his insights on the fixed income market. Sir Smith, there are lots of confusion regarding the direction of the interest rates for the remainder of this year. What is your call on interest rates?
Yes. Hi, Mariel. Well, this year has been quite a surprise for the market. No? Coming into this new year, analysts and investors were bearish on rates. They were expecting the central banks to start hiking rates soon, and therefore a lot were positioned defensively. As the past 5 months unfolded, what we've seen is that the growth factors and inflation factors in the US has actually been very muted. And as a result of that, we've seen rates come down in the US markets. No? At the same time, as we look forward, we've also seen that the drivers of growth and inflation are probably also going to be benign. And this is expressed also by the views by the Federal Reserve in the US. As a result of that, the projected rate hike in the US has actually started to be sliding back to beyond 2015. And this has actually affected a lot of the markets, including that of the Philippines. Here in the Philippines, we expect the BSP to hike rates by 25 basis points to 50 basis points. This is on the back of being able to control inflation for 2015. And so far what we have seen is that even with the anticipated El Nino, the expectation of that inflation is not that strong. We've seen the long tenor part of the yield curve come down from the beginning of the year. The middle part of the curve, as well as the medium part of the curve, has also come down, but it was still higher than the beginning of the year. So a lot of things have changed. No? So we still believe that Philippine yields are probably going to trend up, but it's going to be a gradual trend up of rates. So we're going to see less volatility this year compared to last year.
So with that, Sir Smith, how are our bond funds, the BPI investment funds and the ALFM bond funds, positioned for this rising interest rate?
For this type of environment, we have actually been positioned defensively by lowering the duration or maturity of our funds. In all our fixed income funds, whether dollar or peso, we are below the benchmark duration or the index duration, and continue to do so going forward. No? I think what is quite notable is we have actually adjusted our duration from the beginning of the year from perhaps maximum underweight to slightly underweight. This is to reflect the current situation where yields are coming lower, but still we expect yields to go higher, so still underweight on the duration of the funds.
Now, with these new defensive strategies adopted by the fund managers, do you think that this will limit the downside risks to your bond funds?
Based on our current view, I think that would be the case. And what is quite important to stress is that things are very fluid. While our assumptions are that things will be, or growth will be more or less range bound, inflation is not going to be a threat. We have to be always watchful of this risk, and therefore we are always monitoring the situation and ready to change the position of the fund. So I think that is part of the active management we're trying to put into our fund management. No? But certainly, we are short on the duration, but we're doing other strategies in order to give our clients yield on their portfolio. Some of our strategies for our funds involve buying corporate bonds for the portfolio to be able to give more yield to the client, while others, where they're more into capital gains, those funds are trading the government securities, no? Where there are opportunities to trade, we would trade it. So I think what we can say is we can never tell that the worst is over or the market is going to be in this kind of situation going forward. But what we can say is that we are actively watching the market and ready to change the position of the fund should it necessitate the change.
In light of weaker than expected U.S. economic data, how will our bond funds perform if the Federal Reserve delays the raising of interest rates in 2015?
That's a very good question, Mariel. And I think what we're seeing already so far this year is the dollar bond funds actually doing better than expected by investors from the beginning of the year. It's probably the second best asset class this year after equities. And what we can see is that if the Federal Reserve delays its rate hike further, then this is going to be good for investors. There's going to be less volatility. There is going to be more of an opportunity to accrue your coupon from the bonds. And this would overall be positive for the returns of investors. No? So similarly for the peso bond funds, that would be the case also. So I think what is quite important is to be able to really be comfortable with this risk and be able to adjust with the risk as they change. So for clients who are risk averse, I think they should continue to invest in those funds that they feel comfortable in, and those who are more of a risk taker, then they should probably continue investing where they are comfortable in, where funds are able to produce returns and capital gains.